Thank you so much for joining us today. Today's going to be fun. I'm hanging out here with Michael Kramer, a very good friend of mine, and we're going to talk about macro and markets. And I think this is the week of
Today's the 21st.
21st. Okay, the
First day of summer.
First day of summer. Okay, perfect. And I want to be where Mike is. Take a look at his background. He's in paradise. Okay,
Yeah.
I'm in my studio here, but he's at the beach. So we'd
Yeah.
rather be where Michael is. How you doing, Michael?
Good. How are you?
Good, good. I'm always have fun and excited to hang out with you as we talk markets and macro. So let's start with the markets. What are you thinking about what the markets have been doing lately with this melt up, and now we had a little pullback? What are you thinking all this?
I think it was a combination of a lot of things that kind of took place at the same window of time. We had the TGA kind of drain going into the debt ceiling that first week of June, which helped add liquidity into the market, although we're seeing signs of that being taken away now. I think you also had the whole window of option expiration, which kept stocks levitated with volatility selling. And now that VIX OPEX is behind us, now that monthly June OPEX is behind us, now that the TGA is starting to refill, now that the Fed is going to continue to raise rates and you're seeing rates move up, I think that's going to, kind of bring reality back to the market at some point, the stock market, right? I mean, equity risk premium has really blown out. You're not really seeing the market respond to higher rates, and inflation is still sticky, just like we've been talking about for what, 6-9 months now, the two of us.
Absolutely.
And it's core, and core is coming. Core is really the issue because oil's not even expensive, right? And what's the odds of oil staying at $71 a barrel as we go into the winter season? Plus the Saudis seem to want oil prices to be higher. Plus we know that the US is a buyer of crude around $70 a barrel, as they've stated. So there's just a lot of things that I think are not favorable right now. Yeah, I mean, the economy has pretty much avoided a recession to this point, as we've also spoken about here on a number of occasions.
We have rising core month over month, and I think it's sticky around 5%. And like you said, it doesn't even include that oil, which, it seems like could very well accelerate and rise again with what's been going on with everything.
And that's what I'm getting, that's what the scary part is, right? Is that we still have a core PCE running around 4.75% or so. And you don't even have oil prices to comp off of that are going up, because right now oil prices are comping and pushing inflation down on headline. But once you get into the second half of the year, that's going to suddenly change. And if oil prices start going up, you're comping off lower oil prices, and that's going to start pushing headline back up. And the other thing too is from another standpoint, I guess I can share my screen and show you quickly.
Yes.
What I'm most focused on. Am I sharing the right screen? Yeah.
I love all your screens. It looks great. Let's go into Mike's thinking here.
So the big thing here, right, is that everyone focuses on these they always put out the seasonally adjusted numbers for the month over month. And the problem is that when we look at year over year is measured in a non-seasonally adjusted metric. And so what we found out last year was that the seasonal adjustments didn't really properly reflect inflation, and inflation was indeed running higher and hotter than what we had expected. And people were so busy annualizing 1 month, 3 month, and 6 months averages that they totally missed that inflation was actually much hotter than what was expected. But what was really interesting last year, between June and December, inflation basically just flattened out. So this is the non-seasonally adjusted metric. And I actually have a chart, another one I just remember now. And so what's going to happen is that these comps are going to get increasingly more difficult over the next couple of weeks, because over the next couple of months, because you can see that once we hit June, CPI on a non-seasonal adjusted basis basically flatlined and did nothing. So all of a sudden, right now, when you try to figure out, what inflation's really running at, and you see that since the beginning of December through the latest print, we're running at a 6% annualized rate from where we've started in December.
Mm-hmm.
And what's interesting is that December is basically the same price or level as where it was in June.
Mm.
So what I'm projecting, right, is that right now, the non-seasonally adjusted inflation rate, CPI, for June, based on inflation swaps, is pricing out a 0.4% month over month increase. So now if you take this and you factor this in for June, the first 6 months are running at almost a 6% year over year inflation rate on the year.
Mm-hmm.
And this is telling me that essentially, in order to get inflation down, you're going to need to see the rate of change in inflation be something much, much lower. So essentially, you're going to need the inflation rate that I'm projecting at this point to get it to like a 3% rate. CPI on a non-seasonally adjusted basis needs to rise at about a 0.1% rate every single month for the rest of the year, providing that this was one of my projections, right?
Mm-hmm.
Assuming a 0.1% increase year over year for the rest of the year. If we rise at a 0.1% increase year over year for the rest of month over month for the rest of the year, you'll be at a 3% inflation rate. Anything higher, if we start rising on a non-seasonally adjusted basis month over month on a regular basis at 0.3, 0.4%, you're going to have an inflation rate that's going to resemble something closer to 5. And that's going to go that's going to be the wrong way. And this is, I think, the big risk that no one's really paying attention to because they're too busy trying to annualize the seasonally adjusted numbers, which are giving you, I think, a false sense of where inflation really is.
Yes,
That
I
makes
love
sense.
that. Oh, it absolutely does. I love it. See, this is what we all love about you, Michael. Everything you speak about is based on pure data and these beautiful charts. I love these charts. And that's excellent logic and points that you made. Like I'm looking at CPI right now on the government site, and it has May 2023, all items headline up by 0.1. But like you said, it flatlines during the summer months. So, that's seasonally adjusted. And that's very important to know.
The number you read was seasonally adjusted.
Exactly.
When you look at the non-seasonally adjusted month over month number,
yeah, let's look
we
at
actually
that.
Increased 0.3% last month.
Wow. See?
And so the seasonally adjusted numbers, I think, are going to be shown to understate the actual inflation rate. This is the same thing that happened last year. Plus, the other thing that I think is really interesting is because everyone is so, again, focused on how, rent's coming down. And again, they may very well begin to come down. But if you look at the Zillow rent index, rents haven't come down. The pace of the increases slowed. But this is a Zillow rent index through May. It looks like it's accelerating to me to the upside, doesn't it? After a period of, guess what, flatlining for several months. So this whole idea that, yes, the Zillow rent index, the year over year changes is coming down. But if you look at it on a month over month basis, you can see it's also reaccelerating. And so, how long?
Yeah.
So if we look at the Zillow rent index on a year over year basis, you can see that it's come down. And I think this is giving people this false impression that we're just going to return to something flatline. But you can clearly see when you start looking at the actual data, rents aren't coming down. They're actually accelerating again. The question is, how fast do they accelerate from here? And on top of that, you have the CPI health insurance metrics that are going to reset. If you remember, that big shock came when they did when we got in November, when we got the October CPI data. Remember, that was like sort of the big shock. And it was like a big miss on Cleveland Fed and everything.
Yes.
That was due to this, because health insurance make up about 1% of CPI. And this number has been falling month over month at a 4% rate every single month since last October. This is going to also be reset in this will also be reset in October again. And you know, they do like a dumb way of figuring it out based on insurance companies' retained earnings. But you know, whatever it may be, you know, what are the chances that this thing is going to continue to fall at a 4% rate on a regular basis? 3.7%, 3.8%, negative 4.2%. So this is, you know, basically also under, this is also, you know, providing this false sense of where inflation really is. Because again, if I chart this,
Yeah, this is very important to know this. See, yeah, look at that.
And this is a 1% weighting. Now it's a little bit less. It's like 0.7. But that's, you know, if you're taking 4%, negative 4% every month on a 1% weighting, how much is that taking away from headline CPI? Which is why you've seen PCE stay stickier. PCE has different weightings and metrics in them. They do things differently, which is why the Fed doesn't look at CPI and it focuses more on PCE. Because PCE also underweights housing, where in CPI they overweight housing. So all of these things, I think, ultimately are going to again show us that, you know, inflation is going to remain somewhat sticky and elevated, and specifically core is going to remain sticky and elevated. Because again, like if we look at what they call, you know, super core, PCE X, hold on. Less housing.
Oh yeah.
This is
how do you remember all these different?
I just do. You see where it is? 4.6%. This is less housing. This is the Powell metric. You know, does this number look like it's coming down, or does it look like it's maybe trending higher?
I'm going to tell you, you and I know charts. You're a master at charts. And when you look at that trajectory, it looks like it's going up. It does not look like it's going down.
No, look, here's a low 3.9.
Yeah, higher
here's
highs.
A high 4.7, low
higher lows.
4.3, high 4.8. You know, it's making higher highs and lower highs and higher highs. I mean, it could come down this month, sure.
Yeah.
But it's not. But now look at this now, though. You go to Bloomberg Core, Super Core, they call it. CPI, the same thing, less housing. Now look, it's going to be it's going to give you a different impression. Oh, wait, that's the chart. Sorry. Bloomberg Super Core year over year. It looks different, doesn't it?
Yeah.
But notice the number is still 4.6%, right? So this number, it looks to me like people are looking at this data and they're trying to project and say that, you know, core PCE less housing, and then you compare CPI less housing, you could see that it looks to me like CPI overstates and PCE is understating. But somewhere in here is the truth, right? And my guess is that if you're sort of doing the analysis and you're looking at this, you may be thinking that, yeah, well, but now super core is coming down, but really, again, because PCE underweights housing compared to CPI, you're not really seeing that happen. You're not seeing that same effect.
Exactly right. Well, this is very concerning. You know, I think you and I can both agree that we're on this trajectory. It's pretty consistent. It's very sticky. And we all know prices are elevated, and only a recession can really help bring that all down. And it seems like a recession is in the cards probably for next year.
Yeah, I mean, when you look at, again, there are very few examples in recent history that when, you know, you've seen CPI really come down without a recession.
Yeah, and 15 was it?
You see, let me just.
Yeah, look at that.
So, I mean, there are there are some examples where it flatlined, but if you really want prices to come down, here you can see in 2000 they went up and then they came down. Here you can see the big decline in 2008, prices actually deflated. But the odds of there being some sort of big move down in prices, this was one example in that period of time. But my guess would be that you actually need to see a full recession to really start bringing this down.
Yeah, that's very high, and it seems like a recession most likely needed to bring down these prices. You know, as the demand reels in, then at that point, we're going to start seeing prices come down, and it needs to occur. I mean, everyone's talking about, you know, prices are so elevated, even in housing, right? Our real estate here on Long Island is still elevated, right?
Yeah, it hasn't come down.
No.
They're still going up, I think.
Yeah,
At least based
exactly.
on the houses I see for sale,
Exactly.
because there aren't many.
Yeah, the historical low inventory. So, you know, the Fed technically trap people in their homes. They have, you know, they gave them the lowest rates, I think, in a very long time, if ever. You know,
Yeah.
people have 2%, you know, mortgage rates. And so they're just holding on to their homes and they're not selling them based on that low rate.
That's right. I mean, if you refinanced in 2020, you probably have a 2.5 to 2.75% interest rate. Are you going to really go out and buy a new house
No,
unless you absolutely need to at a 7% rate? If you need to
right?
take a mortgage, you're not going to do it.
No,
You're
you're
never going to
not.
sell.
You're just gonna, and I'm seeing, you know what I noticed in our area, is that there's a rise in a lot of home improvements. Like I see a lot of
Yeah.
handyman around, they're all busy. I need to get some work done. And it was like, the guy told me, oh, September. I was like, what? I've never,
Yeah.
he's like, oh,
My neighbor started a project on his house last Memorial Day, like in May of 2022. They're still doing work on it because that's how long it's taking to get all the pieces and parts that they need to do it.
yeah. It's a real, and then everyone's staying in their homes, so they're just fixing them up. They're not selling them. So there's like a very strange phenomenon that's like an artificial, that the Fed created by lowering the rates, negative rates, free money, and there are repercussions from that. And I think this is all going to play out over the course of many years. You know, like Drunken Miller said, he thinks it's going to be a sideways decade. You know, it's going to be difficult times ahead, and I think it's going to take time, especially that it's income driven in this growth cycle. And we have, you know, wages are still elevated. Have you been looking at wages and how they're
It depends on what wages you're looking at, right?
yeah.
Because it feels like there's many different ways to measure it.
There are.
And all of them, show that it's they're still very elevated. I look at the Atlanta Fed
That's what,
mostly.
that's what I usually look at as well. It's more general. It's not specific in different sectors or anything
Right.
in industries, but it's just a general trend, and we'll speak for the overall pattern that wages are higher, and and that keeps driving that consumption, that elevation in prices. It's like it maintains that level. So it's going to take time, and the demand does need to come in. And I think with the recession, we'll see that demand coming in.
A lot of people, I don't know how they think about things. I don't know, what their process is.
Maybe they don't think. How about that one?
I mean, it's possible, but so I look at nominal
Yes.
growth, right? And this is non-seasonally adjusted nominal growth, right? And they're just giving you the value. So when I transform it into a oh, I forgot. This is how I have to. There's a special way I have to do this. Hold on. I forgot. So when you look at this, right, and you're looking at a year over year, a true year over year number, not a quarter over quarter seasonally adjusted annualized rate, like a true year over year growth rate, a nominal GDP, non-seasonally adjusted. Look at how much growth there is still in this economy. It's 7.8%, right?
Yeah.
On a pure non-seasonally adjusted year over year metric, not again seasonally adjusted annualized rate, but this is an actual year over year number, and it accelerated from, you know, a 7.3 in the fourth quarter to a 7.8 in the first quarter. I mean, right now, this economy on in nominal terms is growing than it did faster than it did in all of the 1990s. And most of this is just inflation.
Exactly. So that's, like we said, that's why a recession is most likely needed. And for this economic cycle.
But do you realize, though, think about how much pain it will
Yes.
take to get a real recession.
Yes, with that GDP.
Because you got to get it down to 0.
Mm-hmm.
Which is, you know, somewhere down in here. It's not allowing me to move the cursor. But I mean, you're talking about 0, right? We're here right now. So I mean, that to me is that's a lot of pain.
Yeah, well, the government is spending to no end. You know, we have this massive debt that just keeps increasing. So we know the government is not going to be cutting back on their spending. So it's going to have to hurt. It's going to come from the private sector. So it's small businesses may.
But also, this is why, you know, earnings have held up.
Of course. Yes.
You know, I mean, this is one of the reasons why we're probably going to still have another. I mean, you're still going to have probably, you know, a few more quarters of this number having to decelerate in order to get you into a recession.
Exactly. And there's a lag. There's a lag 12, 24 months on something.
So and the other part being that
but not the labor participation rates, not in labor.
No, wait, I gotta find it now.
Okay.
But there's also been structural changes. And this is the biggest thing that I think people are missing, right? Look at that. Wow. You went from 94 million people, 95 million people not in the labor force in the beginning of 2020 to 99, almost 100 million people not in the labor force today. 5 million people have just vanished, not coming back to work. And why do you think it is then that we have, you know, 10 million job openings? Because if you look here, there was 95 million. We went up by 5 million. Here, there was 7.1 million. It went up to how much? 12.1 million. How much? What's 12.1 minus 7.1? It's 5 million people.
Well, so, there's a lot. Yeah. I mean,
you know, where would, you know, would you have 10 million job openings today if 5 million people that were in the workforce went back to work? No. So how much are you going to have to pay these people to come off the sidelines?
Yeah. Well, as more bills come due, benefits and higher cost of debt and capital, maybe they're going to be.
But maybe they're making a ton of money in their 401k. Maybe they're looking at say, I don't need to go back to work. I got, you know, look how much money I made over the last 3 or 4 years. I don't know. I don't know what the psychology is behind it, but this is a structural shift. Something dramatically changed here.
Yes.
All these people just decided to pack it up and go home. And what's funny is that, or what's not funny, is that when you look at other metrics, you know, when you look at just the labor force size, that hasn't even grown by that, you know, by that much. It's gone from, you know, it was at 165 million and now it's 167 million. So that the whole labor force only went up by 2 million people over this period of time.
I think what we could say is that COVID and the shutdowns and everything definitely had a very negative effect on all this and skewed everything. And it's going to be lasting for many years, I think, before it normalizes, if ever. I mean, it just seems that, you know, there was a paper written by Stephen Hanke. They did research on this and they said that it was the biggest policy error ever in modern history, shutting down all the businesses and everything. Then they gave out, right?
It was you know, it was all of the fiscal spending.
Yeah, and giving people all this, all the money and everything. And it just, maybe they were good at money management and they're able to let that money last because we know benefits are ending, bills are coming due, and you know,
loans are going to start coming due.
Exactly, the forbearance is ending.
I mean, the only other, you know, the only thing that we're sort of leaving out in this equation is how much did the economy just shift that now you have more people who are, no longer reporting to work and they're working for themselves. But
Yes.
remember, though, this is coming from the household survey. This isn't coming from these data points. The people not in the labor force and the unemployment rate come from the household survey, not the establishment survey.
Yes.
So these people, even though they may be working for Uber, should still be considering themselves working, even though they're working for themselves. So
Yeah.
I don't know the whole, but there you can clearly see that there's a very big change. And so if there is a big change and these are structural shifts, what we're kind of brought back to is that interest rates need to be higher. And I think we may permanently higher interest rate environment for some time again, until we have a major recession like 2008 that sort of resets the clock. Otherwise, I think we're sort of in a higher rate world.
I agree.
And I think markets for
Completely.
the most part have mispriced that.
Absolutely. I completely agree with you. I think we're in a new regime. I think we're going to stay higher for longer. And what I mean by that is that I don't think we're necessarily going to go higher, but we're going to stay in this range for a longer time period, and I think it's going to probably last for many years. Of course, we can't speak for, 6 months, a year from now, but as you said, like a recession would definitely bring them down, but they're not going to go back to a free money negative rates. I mean, it was a terrible situation, bad decision making, in my opinion, to have gone to that. I mean, the banking crisis is a symptom of all these negative rates. Look at the duration risk and the unrealized losses with sovereign bonds. I mean, we have, the balance sheets are off and, mark to market. And so we know that those were mistakes. So we're probably not going to be headed in that time period, back to that time period with those low rates. So we're going to remain elevated.
Right.
And we should. I mean, we should be at a higher rate.
The Fed is going to have to keep raising rates. I mean, this is the first time since 1970 that the 30-year bond is trading below core PCE.
Wow. I mean,
look at that.
Crazy. And the inversion.
Not once. Not during the whole 1970s or 80s did the 30-year ever trade below core PCE. And now it's done it since April of 2021.
Well, it's obviously
so it tells me that the market doesn't actually believe that inflation is going to stay elevated, because if it did, it would be trading higher than the core PCE rate.
Yeah, well, I want to talk about the inversion. And we mentioned, as we spoke before we started recording, about the 3-month now compared to, you have the 2-year, the 10-year. The inversion, I think, has gotten even steeper. Is that correct?
For the earnings yield of the S&P?
Well, that as well, but also the inversion.
Oh, the yield curve inversion.
Yes.
Yeah, so that has gotten, it's almost back to negative 100 basis points.
Wow.
Here.
I mean, that has predicted recessions for, it's a historical pattern, and there's a good reason for it.
I just have to find the chart. I've already
and in the establishment and household survey, there's also disparity in how they collect that data. And, multiple job holders are counted multiple times, and they're over, those numbers are off. So there's a lot of, issues with all the data that we have. It's not always reflective of the true economic picture.
No. So this is, the white one is the 10-year minus the 3-month, all the way down here.
Wow.
And the yellow one is the 10 minus 2. Down at 90.
So let's look at the patterns. Look at the history. When it comes down this far, look what happens.
Yeah. You want to see something else?
Yeah. Show me.
Yeah. Look at that.
Wow.
It's like magic.
It is magic.
How the two just track each other perfectly.
These are beautiful. I have to say the patterns are it's just amazing how they follow each other like that.
Yeah, because the spread is just merely following the unemployment rate. The market knows that the second unemployment starts to rise, the Fed is going to start cutting. And so the 2-year starts trading down to the 10, and the yield and the curve re-steepens. But the reason why we've been in inversion this deep for so long, notice here, if you go here where we topped out, right, back in April of 23 when the Fed started raising rates, the reason why the inversion keeps going down and it's lasting so long is because the unemployment rate hasn't risen.
Yes.
If you go back to 2008, here you can see that the second as soon as the market got a whiff that jobs were going to start leaving, the curve started to re-steepen.
Wow. Just looking at those patterns, it seems that the recession is most likely needed in order to normalize this pattern.
Or the Fed needs to start cutting rates.
Well, I don't see how that is. In my opinion, I don't see how they're going to start doing that unless something breaks or something happens like a severe recession.
Yeah, I don't know. My guess is that, there's just still too much. There's still too much inflation in the economy, and there's still too much nominal growth. And because there's a structural shift in the labor market, I think what you're seeing is basically a new economy. It's just different. And I think everything of the last 10 or 15 years you can just throw out the window and forget. Because I think that with 5 million people leaving the labor force, only 2 million more coming in, 10 million job, what are we still at 10.1 million job openings? It took basically from the beginning of COVID, when we got that full recovery, to add 2 million jobs. So going on almost 3 years now, or more than 3 years, I guess, post COVID, you've only added 2 million jobs to the total labor force. And we still have 10 million that are vacant. So is it going to take another 3 years to take another 2 million off, and then another 3 years to take that's 6 years from now?
So then the question is, Michael, do you think we could be in a sideways pattern for many years?
For the market?
The market and just the economy just drifting along in this fashion and staying in this area?
No, I just think we have to accept the fact that we're in a higher rate world. And as we can see, the market just doesn't believe that yet. I mean the bond market and the equity
oh my God,
market.
there's a disconnect between the bond and the stock market.
There's going to be a moment where the market wakes up. I don't know when that moment will be, but there will be a moment in time when the market goes, oh my God, rates are never going to come down. Like inflation is something that's going to be more persistent than we priced in. And the market is going to wake up, rates are going to adjust very violently, and you're going to see it eventually reflect in the stock market. I don't know when that time will be. It could be the next CPI print. It could be at some point next. If there is going to be a time, I would probably wager that it would probably come sometime in September to October timeframe, because that's when those base effects that we're talking about with the CPI report, that's when you're going to see the true ramp of, like I was showing you, where people are going to start realizing that this effect basically has allowed this effect here. Once we start getting through here, you're going to start seeing that these inflation rates, if we continue on this type of trend, which, let's face facts, that trend can continue, because at the end of the day, this to me is no different than looking at, a chart of a stock.
Exactly.
There's your trend line. So if that's your trend line and we continue to trade, go up above it or around, kind of bob and weave around it, when you hit this point, you're going to be basically comping off the same number that you comped off 6 months earlier. And, this is just going to create, so this is June and this is April. So if that's your 3% number, well, let's just drag this number out, further. And now we start comping off of, these other numbers here. So let's just pick a random number and we'll do September. So we go out to the September and we're going to comp off of, a September to September. If I can do it, because this chart's not very good. Here you're talking about 4.2%, right?
Mm-hmm.
Now let's go out to November, if I can. This is one thing they don't do well, is make charts. So now we got to take this number and drag it to November. Oh my God.
You know, as you're doing that, I think
You see it's 4.7 now,
oh yeah, look at that.
right? And now what's going to happen when you get to December, you're going to see the same. And now December, actually, the value goes down. So you're
Okay.
back to 5.6%. If we just follow this the trend that
Trajectory.
we've been on,
Yeah,
so to
the
speak.
trend. I
Roughly,
love,
this
yeah.
isn't, exact science here,
Yeah,
but again, it could even be higher. It could be, a number that's closer to 6%. And then if you look at what the swap market is pricing in, 12 months out from now, you're looking at 2.2%. But that's a big, I mean, basically the market's pricing in this idea that CPI is just going to go sideways for the rest of, time, for the next 12 months. So this chart, this point in time, instead of it being on a trend that goes higher, it's going to be on a trend that just, basically goes like this, or maybe something slightly higher, but basically where you're not going anywhere.
Yeah, that's what I mean, like a sideways in the economy, in the market, and just everything. We're just like in this pattern of just like a waiting period. Everyone thinks there's a recession. When's the recession? And then this inflation, it's going down. Then it can reaccelerate. It's like, yeah. And then it's the labor force is key. That's absolutely key.
But personally for me, if I had to choose the lesser of two evils, right? Like I'm bearish, but I'm bearish because I think that equity market's not pricing in the right interest rate risk, and it's not reflecting what bonds are trading, right? That's different than being bearish because you think a recession is coming. People don't understand that distinction with my view. My view is actually the rosy view. The negative view, the really bearish view, would be if CPI were to flatten out, have no growth, or go down. That would mean you are in a hardcore recession and prices are actually falling. Yes. And that would be a total collapse of earnings in a higher interest rate world, which would just crush multiples. So I'm actually very much hoping for the market just adjusting to a higher rate environment, because that we can live with. That will allow earnings to continue to expand. Yes, there will be a 10 or 15 or 20% correction, but over time, the market can grow with that inflation rate, with that economic backdrop, once it's made a full adjustment to interest rate policy. If we actually have a full-blown recession, then you're talking about multiple contraction. You're talking about earnings and revenues declining. And then you're talking about something much steeper.
Yeah, well, I agree with you on the adjusting to higher rates. I think the market isn't reflecting that. I think that's going to inevitably occur unless the rates come down. And how are the rates going to come down? Something breaks, a severe recession, hardships, right? And so here's how I'm going to just say how I see it. Okay, go on.
Look, this is 1970s. These are rolling moves in the market.
Yes.
Do you realize how big these moves actually are just by looking at them? You would have no idea. This was a 73% increase, right? This is call it a 48% drop. This happened multiple times. See, a 45% increase, followed by a 35% drop. This happened
I think that the 70s and 80s are a good place to look at for patterns. And, history rhymes. It doesn't match exactly, like we all know. But I think that's an excellent time period to be looking at. And then I know you talk about stagflation, and that's still on the table.
And these were rolling recessions, right?
Yeah, I think that we could see two bear markets back to back.
Yeah, I mean, it's happened before.
Mm-hmm.
I mean, so again, if I had my choice, I just want stocks to reset to a valuation that makes sense, and for us to live in an environment basically where inflation moderates over time, and we just have, some, and we keep inflation's at a rate at least that it can grow modestly, earnings can continue to grow, but we're not getting either one at this point.
No,
Like, the
we're
market's
not.
not believing inflation's going to be sticky.
That's what
It's
I'm
not
saying. We're at a
accepting.
standstill. Yeah,
It still believes what we've learned for the last 15 prior years, not thinking that something has changed.
exactly. The recency bias. So
Right.
I think, okay, so inflation, we had, earnings weren't as bad, but, margins were compressed. However, the top number was still elevated due to higher prices from inflation. And inflation works both ways. So it held up prices. So we get into recessionary conditions. We have demand reeling in, which we're starting to see the consumers pinched, and it's starting to come down. And, higher cost of debt and capital is key. People aren't going to be putting as much money on their credit cards if it's at a higher rate. And, more bills are coming due. Let's say we get recessionary conditions, like Steve Hanke, the economist, said Q1 2024, due to the shrinking in the money supply and the lag in inflation, 12 to 24 months. And let's say we get to that point. So now you're going to have margins compressed, right? Prices are still, those margins take a while, and it's still going to be tough. And then demand's going to come down. See, it's a longer growth cycle. It's a longer economic cycle with wages and income driving that. So you're going to see the demand come down and then prices are going to start coming down. Top number is going to come down. Margins are compressed. And what's going to happen to earnings? You're going to be really down, right?
Yeah, I mean, but you may even be in an environment where the worst case would be if you can't, if I don't think you're going to be in an environment necessarily where prices are going to come down. They may come down on asset values, like housing
Asset values
and
for
stuff.
sure. Yeah.
But what I think is most likely to happen is that companies will be unable to pass costs on to consumers anymore.
So they're going to
Their
have to
margins will
lower.
get crushed.
Yeah. And then they're going to have to
And then that
lower
will just hit
prices.
earnings, right? And that will
Yeah.
also lead to layoffs and job loss eventually,
Mhm.
if that were to happen. But again, that's why I think my view of just sort of, moderating inflation, keeping the economy strong, just adjusting to a higher rate world would really do a lot to, I think, help things along, as opposed to
Yeah. I mean, that's
having to tighten monetary policy so much that it actually causes a recession. And the market really is not helping the Fed at all, because by doing what it's doing, it's loosening financial conditions, it's giving people more spending power, which is actually forcing the Fed to have to keep raising rates.
Yeah. Well, the money supply. I think we should talk about the velocity of money supply. Milton Friedman, great economist, said, inflation is always and everywhere a monetary phenomenon. And we know the money supply has been shrinking significantly, fastest since the 1930s. And, it's since April 22, the money supply has plunged by 4.6%, and
Right.
it's on a decline. We have a credit crunch as well. About 85% of the money supply is actually from the commercial banks.
Right.
And so we have the credit crunch. Look, there's a lower supply and demand in lending. And then, okay, great chart there. Federal was okay. And then, so that's, that is leading us into a recession, in my opinion. With all this tightening, it's okay. So tell us what this chart means.
So this is basically, the white line is the M2 money supply. The blue line is
M2.
deposits held at banks.
Okay. So it's starting to
So
come down.
I'm sorry, the white line is the banks that deposit at banks, and the blue line is M2. And the white line leads the blue line, obviously, because we get the blue line only once a month. The white line we get once a week. And it's showing you that there's going to be still continued further contraction in the money supply.
I think there
Now,
must be a lag by, I think 1 to 9, is it 9 months or something
well,
like
yeah,
that?
I mean, the M2 number doesn't come out. It only comes out once a month now.
So it's like
And the bank deposit data comes out once a week. So what this tells us is that when we see M2 come out, it should mean that we see M2 continue to contract.
Mm-hmm.
But the problem with M2, from what I understand, is that it doesn't include institutional money market accounts.
Mm-hmm.
So what I do is I recreated the MZM model,
Mm-hmm.
and because they don't
They
publish
don't
MZM.
publish it anymore, right?
No. So my understanding is that MZM is basically M2 plus institutional money market accounts minus small time deposits. And when you start factoring in some of these other things, you'll see that it's sort of maybe leveling off a little bit. This updates once M2 comes out, and then everything will get corrected. It gives me a good sense of where money supply is outside of just M2. And you can see that it's kind of stopped going down, at least for now, because again, it's leaving banks and it's just going into money markets, right? So
Mm-hmm.
they're kind of canceling each other out.
Yeah, well, hey, I put my money in money market as well, and you get 4 or 5%. Why not, right?
Right. And so, you know, it's I don't know. The velocity obviously is a big thing, and I've been trying to I try to look at it, and I also recreated MZM velocity, and what I've found is that when you take MZM, you, instead of looking at the actual velocity, you look at the growth rate of the velocity.
Mm-hmm.
That can tell you quite a bit about where inflation is heading. Kind of. I'm a little lost right now with it because you're seeing
Mm-hmm.
this big divergence.
Look at that. Wow.
But historically, if you go back, and I only have, you could see this data, but you can see that there's some sort of pattern to it. It's not a perfect pattern. I think sometimes MZM may even lead
Mm-hmm.
the change in CPI.
Well, I think it's starting to go back to that pattern. I see the white line is leading.
Yeah, the white line is my line. And now I just added in the orange line, which was the old official statistics. And then what I'll do is I'll adjust this as well, the growth rate, and you'll see that the two line up pretty well. And then we can go back to like 19.
So they stopped right in that time period of 2020. Is that a
They-
coincidence?
Yeah, the data stopped right here.
Is that a coincidence?
I don't know. But you can see how my line, and the orange line match up
Yeah.
fairly well, right?
Exactly. Yeah.
And I think that's the point, right? So if we look at the rate of change in the velocity of money, it kind of gives us a little bit of a sense in terms of what's happening with inflation. I think overall, I just don't understand like what's happening here, because this is actually suggesting that inflation is still running rather high, and this is telling you that it's coming down, but you can see that over time that hasn't really been consistent. So, I'm kind of lost right now with this. And the other thing too is like, I watched your interview, that the part that you published at least, and the quantity theory of money he mentioned, I think.
Yeah, Steve Hanke.
And so I was trying to back into things and figure out, if like what the true real inflation rate is in the economy. Because if you take the we know the velocity, we know nominal, and we know real, and technically real minus inflation, or nominal minus inflation, should give you real. And so I was trying to like basically go through an exercise of trying to figure out like if we know what the velocity is and we know what real GDP is projected to be, can we figure out where nominal growth is and how much can it come down? And so I'm still in the process of trying to work through some of that stuff.
Yeah, it's algebraic principles. So you're just
Right.
going to figure it out that way. And he made a good point. The MV equals PY. And he has a special golden growth rate, and he has the change in the money supply is equal to the change in the price level, and plus the change in the real economic activity, plus the change in velocity, which is the word what you're talking about. And
Right.
he had come up with that formula, and he said that it should be 2% plus 2% plus 2%, and that the change in velocity should be 2%. And so the change in the money supply should be 6% per year in
Right.
order to have the 2% inflation rate.
Right. And what I've also what was I gonna say? Just give me 1 second. I'm having like a brain freeze.
So many charts.
Let me do it on the Fred. Because I have an idea. I want to show you something.
Yeah, let's see. It's fun.
So here's MZM, which we don't have anymore, right? And then we're going to put in GDP, nominal GDP, gross domestic product. And then, then I got to put in, I'm just trying to remember how I did it.
Yeah, this is
MZM.
cool.
And then what we got to do is that, we leave that. So we want to do percentage change from a year ago. Oops. And so I had done this a long time ago. And when you said that, it made me think about something. So the reason why I think we had deflation during the last decade was because you can see that nominal GDP was growing slower than MZM.
Mm-hmm.
And you can see here, the chart doesn't continue, but if you were to look at MZM now, and because MZM is declining, nominal GDP has surpassed, I'll show you here.
Mm.
You'll have to, I guess, edit some of this.
That's okay.
I just think it's interesting.
I think it's fascinating. I think this is great.
Okay, now what's going to happen? You see here how the blue line is nominal GDP and it surpassed
Yeah.
the MZM is coming down.
Mm-hmm.
Now, if we just transform it and do growth rate, and we do growth rate, you'll see here again, MZM was growing at a faster pace than nominal GDP. And then like it started to change in 2018.
Yeah.
The blue line is your, the orange line is your CPI rate, right?
Mm-hmm.
And we're going to do separate accesses. So here's your orange line.
Okay, orange line is CPI.
CPI.
And what's the blue line?
The blue line is GDP.
GDP, and what's the white
The
line?
white line is MZM.
Ooh, look at that.
So you notice here how CPI is sort of subdued, and falling because you had MZM growing at a faster pace than nominal GDP. Is that right? No. This is why I hate this with the charts. Hold on, let me add it here. Maybe it's easier.
I think that's a great, the white line is very, very important there. That's cool. You can coordinate it like that.
Yeah, what I'm trying to show you is that if you look here, again, MZM is growing at a faster pace than the blue line, which is gross domestic product, and consumer prices is green. If you notice here, when you start, kind of coming back, and you can see here the green line being inflation, you can see that once you got to a period in time where MZM was growing at a slower pace than nominal GDP. You had a little bit of an uptick in inflation on the blue line. And when we get to this period of time here, we have big growth in
Money supply.
in money supply, and then it comes down, and then all of a sudden it's falling now.
Yeah.
And GDP is growing at a much faster pace than that of money supply, which I think is ultimately led to this inflation. And what this sort of implies to me is that because growth is so much higher than the MZM money growth or M2 money growth, velocity has to continue to go higher until you get to a point where money supply growth is exceeding that of nominal growth. And once you get to that point, you'll get deflationary forces again.
Mm-hmm.
And it's been really hard for me to figure out how to explain this. But the way I think about it is that, let's say you have a stock. When a stock doesn't have many shares that are issued, what happens to the stock if there's a lot of demand for it?
Price goes up.
Right. So if you have the same stock and then the company comes and issues more shares and it's greater than the amount of demand there is, what happens to the price?
Comes down.
Right. And I think it's the same
Supply and
concept.
demand. Yeah. Supply and demand.
Right. And your velocity represents the price.
I love this.
Demand would represent GDP, and your money is your money supply. When there's less money supply, there's great demand, prices go up. When there's too much money supply and not enough demand, prices go down. And that's the way I've been thinking about it. It's not conceptually, it's hard for me to get my brain around it, but that's how I've kind of thought about it. And so if my theory is right, then we should continue to have higher inflation for much longer because money supply has just stopped growing. And it's going to take a long time for nominal growth to come down to money supply growth again.
Yeah, exactly. And we'll call this the Kramer formula. And it's
it's funny. I wrote about this in 2016. So I used to write stories on thestreet.com. I'll show it to you actually.
That'd be great. They're very cool. Look at that. They keep wanting to make you a Kramer with the C.
Yeah, I know. Articles by Michael Kramer. There I am. I'm much younger there.
Oh yeah, your baby over there.
Yeah. YQE4 is coming. On demand generation or negative rates.
This is so cool. You should repost it.
I wish I can remember.
Blast from the past. That's cool. Well, we know the money supply is coming down significantly. So
yes.
It's tumbled down and down 4.6% since April 22. And if the Fed continues on its path, it shall continue to come down. So very concerning stuff. And it's just hurting the consumer, and small businesses especially are getting very sensitive to all this and are getting negatively affected by it. We all are.
Yeah.
Everyone.
I wish I could find it. I don't.
That's so cool.
I'll send it to you later.
Find it. Yeah, send it to me. I want to see it.
Yeah.
We're going to call this the Kramer economic theory.
I don't know about that, but again, like it's kind of funny that I wrote about this really long time ago, and that's basically how things are sort of working at this point. So that's my little theory.
That's cool. It's the
if I find it, I'll send it to you.
Kramer economic theory. We got to get into that. Should be a class that we teach.
Right.
This is cool. I'd like to go into the equity risk premium, because I look at that when I gauge, I want to look at PE ratios as well. When you look to invest in the stocks, and people usually do ETF, they do index investing, and you look at the earnings yield of the indexes, SPX, you look at NASDAQ, and then you look at the risk-free rate, and you say, okay, so I'm actually gaining. It's a different regime, like we talked about. The past 15 years have been, very low rates, negative rates. Your money couldn't accrue any returns anywhere. Now you can. And now risk-free rates, T-bills, even money market accounts are giving you over, 5% plus. So it's a different world. So let's compare the two. I think we're negative, right, on the earnings equity risk premium.
Well, it depends on which one, you look at.
So you pick. Tell us, show us the
I
first
tend to look at the
QQQ, the NASDAQ with the
NASDAQ minus the
tips.
tip, yeah. That seems to make the most sense to me.
It's coming into a
You could
negative.
see it's all the way down.
Wow,
here.
look at that. See, I love looking at history. And when was the last time it was here?
Here,
And that's
2007, 2008.
yeah, well,
And this has been the average over the last, call it since 2013, the last 10 years. That's 100 and, that's, what is that, 234 basis points higher?
wow.
Do you realize where the NASDAQ would be if that were the case? That would be, you're talking about probably a 30% decline in the NASDAQ.
So then when you look at this, just for all the viewers, isn't the market, the NASDAQ expensive?
According to the bond market, it is. One of these markets is wrong. It's really just that simple.
You think the bond market could be wrong?
One of them is wrong. I don't know which one. I tend to think that bonds are smarter than stocks when it comes to things
that's
that
the
are
general theory.
all economic and all Fed related. But maybe the bond market's wrong on this one. I don't know. Another way that I look at it sometimes too is I take the SPX and
the 10-year.
No, I do the dividend yield minus the 10-year.
Oh, nice.
And that's another way I kind of think about it, because I don't want it all to be the same. So this is a dividend. This is a 3-month minus the, and then I'll take the price of the equity market out. So this is the 3-month minus the S&P 500 12-month dividend yield. And right now it's 3.7%. And you can see that this was
to that's what I do too. I guess we think alike. I always use I look back and I see 2007 and 8.
Here you can see here's the dividend yield. Here's the 3-month. So what's supposed to happen to some degree is you're supposed to see them kind of move together. That's but there's clearly this is a very large disconnect. The thing that I don't know, or we won't know, is what's normal. What was where should it be? Should it be here like it was in 1980, or should it be here like it was in the depths of 2009?
We don't know.
This was where we had runaway inflation. This is where we were borderline crisis, deflation. So for all I know, the equity market could be priced just right.
You look at the time periods there, you see 2008 and then 2000 is where the white line up top starts to come down. And right there, and it crosses over. It was through the recession that we had that it was able to change. This is a 3-month,
the white line.
Yeah. And it's through that recession in 2008 that we saw the white line go below the yellow line or orange.
I thought maybe it'd be better in a log, but it's not. I don't know. That's the thing. It's, again, if we're in new times like we think, and we're in a higher, longer for rate environment, for all I know, maybe this is where it should be valued. It's a really hard thing to judge because we have such little information. So, when we look at these things and we look at them through a period of time, it sort of just gives us these mixed messages at time. And but when the way I sort of justify the thinking or go through the thinking processes, right? This is just one way, to measure the valuation of the S&P 500. There are many other ways to also just, measure the value. And, this is the dividend yield minus the 10-year. So again, you're getting to a point where the spread is 2.15%. This is where it is. You can see this is where it was negative.
Okay, so for everyone, just quick question. Why do you use the dividend 12-month minus the 10-year?
Well, because I want to try to get some value from the S&P 500 that's also in percentage terms.
Nice. Okay.
So you can either use the dividend yield or you can use the earnings yield.
Mm-hmm.
I think the dividend yield is actually cleaner than the earnings yield.
Yeah, because I sometimes vary it and I'm not sure. I'm like, oh, the dividend, and I go with the earnings yield, but yeah, it gets a little messier than the dividend yield.
Yeah, well, the earnings yield are using, future, you're depending based off of what the earnings growth rate is going to be. There's a lot of other things. I mean, the dividend yield is it just seems simple to me.
Yeah.
But again, it looks to me like we're based off of where things are. Maybe this is some sort of fair valuation, but then when you look at the S&P 500 PE ratio, which is just the inverse of the earnings yield, and then you factor in the growth rate, how do you justify an S&P trading at 20 times earnings for no growth?
How do you?
You don't. You can't because it's not worth 20 times earnings. You're paying.
Okay, so PEs right now, that's what I wanted to go into. PEs right now we looking at NASDAQ or for SPX. Let's go SPX, whatever one you want to go first. Yeah, what are the PE? What's the PE right now?
I think the PE on the S&P is around 20, and I think the NASDAQ's 27 or 28. We'll pull up in a second.
With this rate environment, with the risk-free rates, and we looked at the equity risk premium, to me, those PEs should be coming down. And
so this is for the NASDAQ. I think I'm using 1 year. I think I'm using blended forward, rolling relative next. So this is not for this year. This is for next year.
Blended forward, but those are just expectations.
Those are what the expectations are for next year. So, based on next year's earnings estimates, the NASDAQ's trading at 24 times earnings. The S&P's trading at a little bit over 18.
What is the historical average?
Well, it depends on which one you want to use. The NASDAQ, we just don't have enough data for it to all, and plus it's kind of skewed. But if we take the S&P and you go back to 1960, let's say, I don't think you can go back that far. It's very slow right now.
Everyone must be checking out all the same stuff we're looking at.
Hey, there it goes. So, I mean, this was your bubble. This was your crash. Looks like we could only go back to about 1995 or so.
Okay.
You take the average.
Wow, look at that
do
low.
The average line.
The average.
Here, run it across. It's here somewhere. I got to change the color. Oh.
That's so cool. You can put a ghost in there.
Where is it? Oh, it's in black. We'll make it red. And it should be 16.6.
Oh.
That's the average. But the other way I look at it too is I say, okay, this was a market top. This was around the time of a market. This was the time of a market top. This was a market top. And we're trading somewhere, in a range. Here's what looks to be market tops in here, 2000. This is coming out of the bubble. And, if we look at the 10-year rate, the last time we topped out at these levels, the 10-year was 2.4. Now it's at 3.8. This peak was going into, well, this is 2015. I don't remember what that was.
I think we can fairly say that PE right now of 20.
We're 18 on next year's numbers, yeah.
Yeah, 18 on next year's numbers. Oh yeah, okay. Yeah, 18 on next year's numbers is on the higher end, especially in this new regime that we're in with higher rates.
Right. And that's how I would think about it too. And when you figure that, if you think about it on a PEG ratio, right, 1 for 1, growth equals PE, that's a fairly valued
So
stock,
where do you
right?
see PEs going to? You think 15, 14? Reasonable range where they
Well,
could go or would make sense?
if we look here, right, and look at the bottoms, this was 14, this was 14, this was 5. This was just recently, right?
Mm-hmm.
I mean, if you look at recent history, 14, 15 has been a bottom area, right? The 14, 14, 15. So should we be trading at 18 times next year's? Probably not.
Mm-mm.
Should we be trading at 16? Probably.
Mm-hmm.
Maybe below that, given where rates are, to bring those spreads back. But again, it's hard to say if the market doesn't believe that the Fed is going to be higher for longer or that inflation is going to be sticky, then you can see why those valuations are holding.
Yeah, because it anticipates rate cuts coming without a recession. It's saying everything's going to be fine.
Everything is the way it was before, and nothing has changed.
Yeah, nothing's changed. Rates are going to come back down. And at some point, there's going to be an awakening. And I think that things should change. We don't know when. Of course, the market can stay irrational. But yeah,
the market thinks the Fed's going to be cutting rates. I mean, if we look at where Fed
Michael,
funds,
do you see any reason for the Fed to cut rates?
I mean, with all the data we went through, do I really need to answer that?
That's what I'm saying. I don't see any unless we get a severe recession. We get some type of recession.
I mean, this is what the market's pricing in for rates. It sees it being back at 4.15% by the middle of 24. The Fed's telling you by the end of 24 it's going to be 4.6, and that's only if inflation starts coming down. And they're only pricing in 5.35 for the peak. The Fed just told you last week, and Powell just said again today, it's going to be higher.
Yeah,
probably going to be 5.6. And I'll bet you by the time they get to 5.6, they're going to raise it to 6.
I saw that the Fed watch, I think it was like 80% chance that there's going to be a 25 basis point rate hike. Okay, yeah.
They priced in a full 100 worth of basis points of rate hikes by November. We're going to be one rate hike by the time we get to the middle of July.
Why aren't they looking at this data here?
I'm sure they are. Who, the market or the Fed?
The market.
I mean, this is the market, though.
I mean, the Fed, market. Yeah. But why isn't the market, the equities market is basically telling us that everything's fine, rates are coming down, we're in the same environment, and you have this runaway PE much higher, and we're in a new regime. Rates are higher. And then equity risk premium is basically negative. I mean, it's
on the 3 month, it's negative. Yeah.
Yeah. And so why would I put my money in the market when I can get my T-bills, my risk-free rate yields, returns higher?
I don't know.
Yeah. Looks
like I don't, I mean, you're talking market psychology at this point, and I don't know. The market again is,
I thought I was preaching to the choir.
The market is living under the assumption that the Fed is done raising rates.
Yeah.
But we've heard that the Fed is done raising rates since March, and they've raised them 2 times, and they're strongly suggesting they're going to raise them a third.
It seems like they're just still having the party. The market's having its own little party, and
but there's just too much. There's too much liquidity still in the system, and it's. So the other thing too that I think, going back to the market living in sort of fantasy world with, rate cuts that probably aren't coming, or the pausing of rate hikes, is this idea also that we're starting to see some signs that maybe commodity inflation could be coming back, actually. And it really starts with, what I noticed was the Bloomberg commodity index, which has shown some signs of, breaking out to the upside. In fact, and when we look at the Bloomberg commodity index itself, highly correlated to ISM prices paid. So if we start seeing a movement higher in commodity prices again, chances are this is going to be an indication that we're actually going to start seeing goods inflation return. when we look at the Bloomberg Commodity Index itself, on a continuation, just on a regular chart, what you see is that there's been a very clear downtrend in it.
Yeah.
And it looks like we're very close to potentially breaking that downtrend. There's one here where you just line it up along this way. And then there's another one which goes back further from the sorry.
Okay. Oh, we can see the trend right there.
I mean, you can see it's a very easy trend to pick up, but you can see that from here, as well, that this trend line was broken. So there are signs that, commodity prices could be turning around. And plus you're also seeing, certain things happening in other parts of the market also. Oil prices, for example, have been, I have a better chart.
Oh, yeah. And now I want to look at copper. I mean, copper is usually a bellwether for the market. I think it precedes the trend by I think 3 months.
Yeah. Hold
So
on.
that's another one to look at. They're saying RV sales are another bellwether for the company, for the economy. Did you read that one?
No, that I don't know. You
They're
can see
saying
oil prices have also been showing some signs of strength as well. You can see the RSI has been climbing. You can see there's been a little bit of an uptrend in it. We're down today, but again, it's general. You can see the general trend, the shape of it seems to be suggesting there might be higher prices coming in oil. When you look at gasoline prices, those have been more broadly trending higher as well. You can see that there. When you look at natural gas prices, I was noticing.
Yeah, I saw a great
You can
chart
see
that you
natural-
tweeted. Yeah, that one.
Yeah, you can see natural gas prices also showing some signs of potentially moving up. And this is also important because remember, oil prices have largely been gasoline prices have, because they peaked in the summer of last year, they've been adding a very big disinflationary tailwind to the market, to inflation rates, because we're comping off higher prices. And so that's helping to bring the annualized inflation rate down. But if you start seeing oil prices starting to approach 81 to $90 a barrel again, suddenly you're going to be comping off that disinflationary trend is going to really start to fade. And depending on what happens with things like gasoline, it was right here last August of 22, gasoline prices were actually lower than where they are now. And so if you start seeing things like gasoline really begin to rise again, or oil prices begin to rise again, or nat gas prices begin to rise again, these are going to go from being, disinflationary forces for inflation to inflationary, additive inflationary forces. And that's coming on top of core CPI, which has already been, somewhat elevated for some while now. And you're seeing the same thing in wheat prices.
Yes.
You're seeing the same thing in corn prices.
Yeah, corn.
You're seeing the same thing in
Soybean.
cattle prices.
Cattle, yeah.
This is, very much soybeans I didn't even look at, to be honest. Soybean. You can see that how these things can really start to become additive to inflation prices if you were to get, these breakouts in some of these key commodity indexes. I think Goldman has a commodity index as well. Oh, here's the Bloomberg Commodity Index futures. You can see same chart I basically just showed you on the terminal. Here's your, here's your downtrend, right? And basically you're looking at a scenario where you can begin to see these commodity prices really start to move higher again, and that could really be a big headwind for inflation. It could be additive to inflation, which could push rates higher, right? 2-year rate is on the verge of really breaking out here and potentially moving back up to 5.10. You have the 30-year rate that's also showing signs of strength. This is actually what I consider to be a bullish cup and handle pattern, right? Which could lead to the 30-year moving up back towards the upper end of the range, and the 10-year moving up and breaking out to the upper end of the range, and the TIP ETF also suggesting, potentially more downside there. And you already have, a market that's very, very diverged from where interest rate policy is. Overall, with the relationship between the Qs and the tips, So, I mean, if you start seeing rates moving higher and you start seeing inflation rates moving higher, due to commodity prices, then
Yeah,
it
look
sort
at
of
that.
really changes the game in terms of how people have been thinking about inflation disappearing. And I mean, I think what the most understated fact is that, you know, we still have a core rate of over 5% or just about 5% on both CPI and PCE. And we have a core rate there, and oil is really the biggest risk right now to potentially going higher, because it's coming at sort of, oil right now is really at the midpoint of where it's been all the way back to 2016. If you take out this, bubble, like in,
Mhm.
this dip here that we had during the worst part of the 2020 crisis. I mean, oil's kind of at the middle of the range here. There's nothing to suggest that oil can't really go significantly higher from here.
Absolutely, I
And really,
agree.
and it's the same thing with gasoline. I mean, there's nothing here to say that gasoline prices can't go significantly higher. In fact, they're lower than where they were in 2014.
I recently talked with a commodities trader who's been trading commodities for over 20 years, and her take was that she was bullish on commodities. She thought commodities were going to go up from here, and her take
Right.
was also oil, very
Hmm.
bullish on oil, exactly as you're saying, and what you're seeing seems
Right.
very likely.
I'm just trying to pull up. I mean, this is the
Yeah, that's it.
Invesco.
That's the commodity index tracking fund. I like that. I was going to suggest that one.
Yeah.
And then there's a ComT, and
I mean,
there's
it's basically the same thing.
mm-hmm.
And you can see, I mean, it just looks to me like this wants to go up. This is, these are
Yes.
bullish patterns.
Mm-hmm.
And so, what is this going to do to inflation if we start seeing commodity prices rising again? Is that gonna lead to, is the consumer now at a point where companies can no longer pass costs on, and you're going to see real margin compression, and that's going
Yes.
to kill,
Yeah.
stock market multiples? Or,
Yeah.
are we just going to continue to see inflation rates really moving up again? And we're going to see that, going back into the second half of the year, due to the base effects we talked about yesterday, right? Or I don't know. How
We
do we
got to
want
it
to?
earlier. I know. Yeah. Well, I agree. I think that, we want best case scenario. And I like how you said earlier, you're hoping that the market re-rates realizes it quietly, that the rates are going to stay higher and adjust. But it seems even more likely that we go into a recession sometime next year, or as you've said before, stagflation, because we'll have elevated inflation along with the recessionary conditions, right?
Right. And the more I kind of go through the work, the more I think that we're heading for a stagflationary period of time. I know that the true definition of a stagflation, I guess, is supposed to be, slow growth, high inflation, rising unemployment.
Yes, yes.
But I'm sort of thinking about stagflation without the unemployment component, where we're just in this, grinding growth rate of 0, 1%,
Yes,
1.5%,
I
and
think so too.
elevated inflation rates. And the reason why I'm not really sold on the unemployment rising too much is just because of that labor gap that we saw yesterday in the number of people not in the labor force.
Yeah.
And that's kind of suggestive that maybe there's just too many. In other words, I think that we could see the job openings decline first
Yes.
without really seeing the unemployment rate rise too much. And if there is a rise in the unemployment rate, it's likely to come at the end, or towards the end of the stagflationary
Exactly.
period,
So that's
as
exactly
people
it.
really have nothing left to cut.
Yeah. See, when businesses put in a lot of time and effort, resources into hiring these workers, they're not going to be cutting these workers when they see things could be turning down. They're going to cut them when they're in the recession, when they're in those times of major contraction, slowdown, demand coming in. So when we start entering that recessionary period, the layoffs could really accelerate rather quickly. So we could actually have an unemployment number that spikes up. Even though we have a lower participation rate, we don't know how fast and how exponentially that can grow because of all these businesses having not only their margins compressed, bottom lines lower, but that top number is going to come down. That's going to be, like you said earlier, that GDP from the private sector coming down will be painful. So at that point, we could see major layoffs.
Yeah, and it's just a question of, when does that come? Because I think they're probably gonna go through the process of trying to squeeze out every ounce of margins they can before they have to get to that point
Yes.
that they are going to have to. But that could be, I think, much later than I think the market is really thinking about.
Exactly. I think so too. It's more of an income driven cycle. So it's going to take, it's like we've been saying, exactly. I love it when we're like, yeah, it's like, basically it's going to we have margins compressed. So that top number is going to have to come down. So you're going to have lower demand, and then prices are going to have to be coming down. Then their margins are going to get hit even more. And then they're going to have to cost reduce. And then the last thing they're going to do is release all these workers that they've worked so hard to attain and to train and to have. And then they're going to have to cut that. So yeah,
right, which would probably makes a recession maybe not till the middle of 2024 type of scenario.
I think, Michael, I have to tell you, I think you and I have both been talking about this sideways, dragged out, grinding market. And it seems that this may be a real, will take lots of time to work through. People are used to the quick recovery, like 2020. They're like, oh, we're just going to bounce back, and it's like, because the government, right? The Fed was right there, saving everyone, but we don't have that.
Look how long it took to come out of the 2000 recession. And that was very mild, right?
Yeah.
It took a long time.
Exactly.
I remember being young at that point. I was young at that point, and it was hard to find a job, even
We're
for
still
someone,
young.
it was even hard then to find a job when you were kind of still entry level, at 22 or 23 years old. It was not easy. It wasn't even easy in 2007 to really find a new job. It certainly wasn't like it was in the 1990s, from what I had seen.
Yes.
It seemed like everyone that I knew was able to get a job really instantly, but it seemed like as soon as I graduated from college in 2000, the job market literally dried up. And, the same thing with the early 90 recession. It just felt like, I was much younger then, but observing it as a kid through the lens of my parents, it seemed like that took a very long time to recover from as well. And I think 2020 was very much an anomaly. And 2008 was, also a very long recovery, I feel like.
Yeah, for the market, I think it was a little faster than 2000 and the previous ones, but it was still a longer one. But 2020 was just very anomaly.
That's not what we're going to see again.
No. And, even if we kept rates at this level, that's still really tightening, because when you think about commercial real estate, which is already suffering, especially their office sector, and, when they're shorter term loans than, home mortgages and residential. So they're going to have to be refining at higher rates, and all short-term variable loans are at higher rates, new loans high at this higher level. And so it's already a significant tightening, even if we didn't go any higher than this. So how's the Fed going to cut when they're data dependent and they're seeing these numbers that we're seeing? You really think they're going to be cutting? The only way they'll be cutting, in my opinion, is if we enter some very, severe recession into next year. And at that point, I think it'll be too late. And I think we're going to have to go through the recessionary, or maybe, like you say, stagflationary period. And it could last 6 to 12 months, right? Maybe longer, who knows, right?
I don't see why not. And if you listen to Powell today, he's talking about, at least 2 more rate hikes.
Yeah.
As long as the economy progresses as they see. And it seems to me, based off of their projections, they've understated the economy in each time. Each one of those dot plot series they've come out with, they've had to ultimately revise their inflation rate higher,
Yes.
or revise their GDP growth rates, or revise their unemployment rates. They're looking for unemployment to be much higher than where they're looking for unemployment to be now at the end of the year. And if those numbers continue to stay elevated, or if we get some sort of commodity surge and you start seeing inflation tick up again going into the back half of the year on, let's say, higher oil prices or higher gasoline, or the other factor too, China's trying to re-stimulate its growth, and that's going to be additive to commodity inflation as well. They're the biggest consumer of many things like copper and iron ore, and which we didn't even look
let's
at,
look
right?
copper.
Copper prices very much look like, to me, that they also want to go higher, as does iron ore prices. And again, these are some basic commodities that they're big consumers of, and if they're stimulating, that's going to be additive to our inflation as well.
Exactly. Let's take a look at gold. How's gold looking? Everyone flees to gold in extreme conditions in the economy.
It doesn't really look that great to me, to be honest. But we'll just have to, I think you just have to kind of see how things go. I mean, the dollar
the dollar
is really going to play a lot in that. If the dollar can break out and begin to rally again and strengthen, that's going to help with commodity inflation.
Is that a cup and handle over there?
Yeah.
So it looks like I can get a nice cup of tea with that.
Nice cup of tea. It's supposed to be, at least. My charts are notoriously known not to be neat and clean.
I can read them.
Yeah.
I see a diamond in there. I see a cup. I see diamonds in cups and handles. I like it.
Yeah, right
and
there.
Flags. Yeah, I see flags.
Yeah.
They got a lot going on, but they're telling you a lot of things. I see that. Look at that cup and handle back there with the flag, and it went right up as your chart
This one, yeah. Right there. Yeah. It looks like that on the 10-year has a lot of that too. Here's another cup and handle right here on the 10-year.
Yeah.
And here's a big flag.
Yeah. So, when I look at all this, both you and I are long investors, and, we go for the long term, but I don't see a case for me to go long at this point. I think there's a lot of uncertainty, and it's very likely we go lower looking at all these charts and all these factors. What do you think?
Yeah, I think I've been defensive. I've been, trying to sell on strength, positions that I no longer want to own, or if I feel like, or I feel like, or if I just feel like they're just names that aren't going to work in the future, like I just have been getting rid of stuff. And I've been very defensive. I've been trying to just hold the high quality defensive sort of names that have been, very have been sort of market leaders at this point. And I'm more than happy to stick with them, because I know that at the end of the day, they're, gonna be stable, at least in terms of their potential for earnings and revenue, and they have strong balance sheets and they can weather a storm. But at the same time, I also have ample amounts of cash, and I'm ready to buy stuff if we start seeing markets come down to something that's more likely to be a sign of some sort of bottoming process, or we start seeing valuations making sense again. And right now we just don't have that, and we don't even have a totally complete clear path in terms of where inflation is heading, because I think that with core PCE and core CPI running at such high levels, it's not going to take much for a move in oil prices or gasoline prices to really get those headline numbers up and to really start freaking everyone out again.
Exactly right. Well said. I think if you're a day trader or short-term trader, there's definitely opportunities with the volatility, with all these movements. But if you're long buy, and long term, and, it's about buying right. And that's where you make your money on the buy side. You need to buy at a right price. So that's key.
And that's partially why, I never really participated in the late 2020 or 2021 rallies. I just kind of sat with what I had, because I couldn't look at a company and find anything that seemed reasonably valued enough that I knew I could own it for the next 3 to 5 years. And that's what I
Mhm.
try to do is hold things with a long-term objective. And if you're buying things at the wrong valuation, then you're not going to make any money because, chances
Mhm.
are the valuation comes down, you're going to get killed. I learned that lesson in 2015 with the biotechs. I owned a lot of biotechs. That was kind of the
Mhm.
peak in the biotech cycle at that point. And I bought them, and a year later, they were all worth a lot less, thinking that
Yeah.
because the valuations I bought them at were just too high. And
Yeah,
so
we
these
learn.
things do matter. Yeah,
Absolutely. We learn from those mistakes and those losses, and we all do. I have as well. I just hope that I use those mistakes to keep making the right choices going forward, and that's why we need to avoid emotionally driven decisions. Now I
right.
want to go into are you looking at the 10-year? I'd like
And
to,
two.
yeah, I mean, we could talk for days about everything. This is so much fun. I love hanging out with you, Michael. The technicals and the options data, the put call ratio and the IV. I know you've been talking about this 1 week 50, the delta on the S&P 500 IV,
Yeah.
and it looked like it was ready to move up. I
Yeah.
love,
So
yeah,
it seems like, the VIX has become sort of obsolete in some ways.
yes,
And so you really have to look at implied volatility on a lot of different metrics. So what I think has been the biggest driver of this rally since we got above, let's say 4,200 or so, is that IV has completely melted. So this is the S&P 1 week 50 delta option implied volatility. You
mm-hmm,
can see that this has just been collapsing over the last couple of weeks, and that's allowed call volume on the S&P 500 to surge, which has pushed prices up. So if this is the case, right, and we're getting to a point here, you can see a falling wedge pattern. If we see IV pop, which is what I'm expecting to happen,
yeah,
you're going to see call volume drop dramatically, and that's going to
and
take the index down with it
yeah,
because
and
there's
those,
going to be
yeah,
no more call volumes to kind of support things and keep things elevated. And
yeah.
so once that happens, I think you'll start seeing the next leg lower start. And I think with the first stop being in this 41 to 4,200 region, and then likely well below that.
Yeah, great thinking there. That's great for planning ahead. Um,
Yeah.
absolutely. Wow. So a lot to look at. How about the put call ratio? Do you look at that?
I don't use it anymore because I think that zero DT option volumes have just completely distorted a lot of it. So I don't
Exactly.
really even pay attention to it anymore.
That's true. I think that the zero DTE has changed a lot of the indicators that we were previously found effective. So I need
That's
to
right.
look at, yeah, I need to look at have new tools here. And this is an excellent one telling
Right.
us
Like you
quite a
can see
bit.
today, this is up today,
Mm-hmm.
but the VIX is down, right? And so you have to look at, oh, it's actually up now. It was looking down on my screen, but you can see that
Mm-hmm.
the point being is that you really need to look at, I think, different metrics. So there's the VIX 1D, which is the 1 day volatility index, which is new, which
Mm-hmm. Oh
is
yeah.
down. You have the VIX 9 day, which is a 9 day volatility index, and which is up just a little bit. And then you have your longer term VIX index, which is up as well. And then you also have to look at the VVIX, which is a measure of implied volatility of the VIX, which
Yes.
is also up.
The
So there's just a lot
VVIX.
of
Yeah.
different things you have to look at when it comes to implied volatility that you didn't have to look at a year or two ago.
Yeah. I read something about, it was very interesting. I'd like to know your thoughts, was that, the energy and commodities were a very crowded trade and they were hedged. And so they got hurt. And
Right,
now everyone rotated to tech. And now tech has had
right.
this huge melt up. It seems that very likely we could have that rotation back. Is that what you're thinking could happen?
Yeah, I mean, the RSP has been really underperforming, and that's because again, you've had this big rotation into the big tech names. So it's certainly a possibility that we could see some of the money move out of tech and move back into some of these more cyclical names.
Mm-hmm.
Certainly, if you start seeing oil going higher, you can certainly see the energy sector perform better. You would certainly, if you see materials doing better, you would certainly see the material sector doing better. those could be places where you could see a rotation into. If we were to start seeing the rotation out of tech, that would make the most sense to me. It would seem to be logical for that to happen. I think though that ultimately speaking, those are probably really the only two sectors that would do well, other than maybe the fact that you would see a rotation into utilities, because again, that's sort of a defensive sector. But I'm not really sure how things like staples would do in an environment where margins may be compressing. Certainly technology and all those, technology like names and communications and communications technology, and what's the other one I'm trying to remember? Biotech, for example.
Healthcare.
Oh, it's consumer discretionaries may not do as well. Healthcare would probably, the XLV would probably do okay in something like that.
Yeah,
So you could
discretionary
see
should
some of
get
the
hit.
sectors.
Retail should get hit, you would think,
Right.
yeah. Well, look at that.
So,
Yeah, like that diamond. So looks like looks like it could go up higher.
it looks like it, at least for now. Yeah.
Wow. Well, that looks great. Thank you so much, Michael. I think that's a wrap. I mean, anything else you would like to add? And I think we covered a lot of ground today.
No, I think that's it. We went over a lot of stuff. Yeah.
Great. Great. Awesome. So we'll be meeting up again soon to discuss the state of the financial markets, bonds,
Okay.
as well as stocks and equities and ETFs and all these great sectors. So thanks so much.
Thank you.